Listen to me. If you are about to retire or you have recently retired and you have a non-qualified deferred compensation plan, what many of you know as an NQDC plan or executive deferral plan, you need to freeze right now and pay very close attention to what I am about to tell you. As so many of you worked so hard for decades, earning a high salary, pushing your bonuses into this deferred compensation bucket because your employer told you, hey, don't pay taxes now, defer it until retirement when you'll be in a lower tax bracket. You thought you were being so smart, saving money on taxes while your income was high. But now, retirement is knocking on your door, or you're already here, and you are terrified because you're realizing something scary. You do not actually control this money the way you control your 401k or your IRA. Here is the exact problem and the fear keeping you up at night. NQDC money is not a qualified retirement plan. It is not protected by ERISA rules. Do you understand what that means? It means that deferred compensation is legally just an unfunded, unsecured promise from your company to pay you in the future. Until that cash hits your personal bank account, that money belongs to your company and sits on their balance sheet, subject to their general creditors. If your company goes under, your deferred compensation can disappear overnight in bankruptcy court. And then comes the tax trap that shocks almost everyone. You ask yourself, Susie, how is this money actually taxed when I retire? Here is the truth, every single dollar that comes out of an NQDC plan is taxed as 100% ordinary income, not capital gains. And because of strict IRS Section 409A rules, you had to elect your distribution schedule years ago, whether that was a lump sum or installments over 5 or 10 years. If you chose a massive lump sum payout upon separation from service, guess what happens? That entire payout gets dumped right on top of your other income in a single year. That can instantly slam you into the highest federal tax bracket, skyrocket your state income taxes, trigger Medicare IRMAA surcharges, and make your Social Security benefits taxable. You thought you deferred taxes to save money, but bad distribution timing can force you to pay more in taxes than if you had taken the money years ago. And do not think for 1 second that you can just call up HR today and say, hey, I changed my mind, can you spread my payouts over 10 years instead of taking a lump sum next month? No, and no. Section 409A strictly forbids accelerating payments or making last-minute changes. If you mess up or try to violate 409A rules, the IRS will hit you with immediate income taxation on the entire balance plus a brutal 20% penalty tax and interest penalties. That is money down the drain. So what is your actionable takeaway right now? What do you need to do today to stand in your financial power and protect yourself? First, pull out your NQDC election documents immediately and examine your payout schedule. Know exactly when distributions begin and how many years they will span. Second, map out your tax strategy before those distributions start. If you have years with large NQDC payouts coming, do not stack other taxable events on top of them. Hold off on taking Roth conversions, delay pulling heavily from traditional IRAs, or consider delaying Social Security if it keeps your overall taxable income lower during peak payout years. Third, evaluate your former employer's financial health. Since your funds are tied to their solvency, keeping a close eye on their corporate stability is vital. And finally, work with a FEOMI certified financial planner and a CPA who specifically specialize in executive compensation and 409A distributions. Do not let tax surprises ruin the peaceful retirement you worked your whole life to build. Be smart, stay informed, and protect your hard-earned money.